This is your host, Caitlin Cook, and welcome back to another episode of the Dead Kate Bounce Experience. This week's guest is Dan Krewson. As market president and director of specialty lending at Huntingdon Valley Bank, Krewson is building commercial and specialty lending divisions, as well as leading the development of several new products, including a crypto stablecoin funded participation facility. Dan and I discuss how Huntingdon Valley Bank, a publicly traded company and highly regulated broker-dealer that has provided traditional consumer and commercial banking services since 1871, facilitated the first ever integration between a traditional bank and decentralized finance protocol. MakerDAO, a fully crypto-native DAO, or Decentralized Autonomous Organization, and the creators of the $5 billion market cap stablecoin DAI, which is, in MakerDAO's words, the first unbiased currency, opened up a $100 million DAI loan to Huntingdon Valley Bank. We provide an overview of DAO structure for those who are unfamiliar, discuss the rules and guardrails that HVB implemented and abided by to make this deal happen, the complex considerations of working with a, by definition, decentralized organization, and more. This story is an important showcase of the ways in which highly regulated traditional institutions are beginning to test the waters, dipping their toes into the growing world of crypto and decentralized finance. With that, please enjoy my conversation with Dan. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of the hosts or any of their affiliates. This podcast is for commercial and informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities or cryptocurrencies, nor is this an offer or sale of a security or cryptocurrency. Dan, welcome to the podcast. Thanks for coming on.
Thanks for asking me, Caitlin.
Yeah, I'm really excited for this one. So kind of beating a dead horse on this for anyone who listens to the podcast, but everything that I try to talk about on here is really just at the intersection of traditional finance and this crazy DeFi world that we find ourselves in, or at least I find myself very deeply rooted in now. And one of the most interesting headlines that I've seen in a while, which is saying a lot, and this is a little bit of an older headline in crypto times. I think this was August of 2022, was MakerDAO opens a $100 million DAI loan to Huntingdon Valley Bank. So straight in the middle, a DAO and a bank doing some sort of transaction, $100 million. Never heard of anything like this before in my life. And I want to get into that with you today. So maybe let's kick things off, probably a little bit easier to explain than, the MakerDAO side of things, but maybe a little bit of background on HVB, your role within the firm, and then we can get into, how this deal with Maker came about, because this is a super interesting story that I want to tell people about.
Great. Well, again, thanks again. So if I'll start maybe at the beginning about, tell a little bit about the bank, about myself. So I'm a career commercial banker, 20 years as a banker, different areas of different, institutions, even, stepping outside of the bank at one point, do some consulting work. But Huntingdon Valley Bank itself is about a $500 million, $600 million community bank based here in Pennsylvania, 150 years old. We are the type of institution that is across the whole nation, has been around forever. We take people's deposits, we lend it out in mortgages and support businesses and all that sort of thing. Nothing really super fancy, like there's no, investment banking, anything like that. It is a bread and butter staple of like American culture. I joined the bank about 3 years ago because we were building a commercial lending division. And as part of that, you really want to have some specialists on hand who understand commercial lending, because it's an easy way to get in trouble as an institution if you go into any type of market that you don't understand. Like, traditionally speaking, like a community bank, for instance, just do it on a real estate basis, geography. Like, we wouldn't go lend in California, right? It just wouldn't happen because, we know our market here in Pennsylvania and the surrounding markets. So we try to stick to our knitting and what we know. That being said, Huntingdon Valley Bank is also a very entrepreneurial company and innovative, and we try to nurture ideas. And so we have an e-commerce bank that we also have inside the institution. We have a digital consumer lending inside the institution. We're probably one of the largest construction lenders in Philadelphia. So there's a lot of, we have a specialty finance. I run specialty finance. We run a specialty finance area that has like lender finance where we lend to other lenders. So there's a lot of different areas where we try to be creative and look forward, but while staying within what a community bank is.
It's refreshing to hear traditional institutions looking forward. And I think the way that you guys have gone about it, at least in, the situation I want to talk about today, is really, really unusual. And I mean that in a good way, because I do think that being open-minded and seeing, skating where the puck is going is really important. And you see a lot of more people on the legacy institution side, legacy finance side, sort of reject a lot of the new trends that come about. Crypto being one for sure, although I wouldn't necessarily call it a trend anymore. But how did the deal with MakerDAO come about, and what were the logistics of that deal? I know we can talk about, the guardrails around how you were creating rules for the deal, why this idea came out about to begin with, working with the DAO. There's a lot to cover there, but what was the original, push for starting a conversation with Maker?
Sure. If I might add like one quick thing is that going back to 9/11, when all the planes in the country were grounded, banks realized that they couldn't process transactions because literally planes carried checks, physical checks across the country in order to be processed at the different, Federal Reserves. So out of that experience came a digitization of the industry. So it started with like Check 21 and the Patriot Act and all that like sort of stuff that led to like mobile depositing and all those sort of things that we take for granted today. I see this, the crypto, and we see this as the crypto as the continued evolution of that, ongoing digital ecosystem that banks will be a part of at some point. The financial system will be a part of. So it's just kind of interesting. This has started a long time ago, and everybody's going to be on board with it at some point. So this in particular, though, all that being said, like none of us at HVB had a experience or an expertise in crypto. Certainly, we've all dabbled in it and invested on the side. But understanding the differences between a stable coin and a non-stable coin and some of the other cryptocurrencies that are out there, or the different protocols, there was really not a lot of understanding about any of that. So this opportunity, when it came into the institution, and it came into the bank because people knew that we foster this environment of innovation. So we got introduced to some folks who were out internally, going backwards, internally at MakerDAO, there was a mandate to look at real world assets, to essentially take the debt vaults that were entirely crypto native and start bringing in some sort of non-crypto investment opportunities for a variety of reasons: diversification of asset class, income, all the reasons that people for 100 years have diversified investments. So we got introduced to one of the teams that was going down this path, who had already did one of these transactions with a private company. And but it was interesting because when we first were introduced to this thing, we're all looking at this and we're coming at this again, fairly progressive, fairly forward thinking, and still saying like, what the hell is this? And it coincided, this first meeting, with I was going down to Miami for Art Basel. And this is November 2021, I think, right? Yeah, 2021. And so it was a huge, the Art Basel that year, in the first week of December, was a huge crypto event. And so I had this call, I go down to Art Basel, all of a sudden there's, I'm meeting all these people, and then, and learned a little bit about like the stable coins and the DAOs and, everything that they're doing. And then you realize, oh, wow, like this is really here, this is cutting edge. So we came home and, picked up the phone, had a conversation. And then that call with those two guys led into hours of conversation of how can we make this work? How can a bank and a DAO work together to each accomplish the different goals that they want to accomplish? And we threw out a whole bunch of different ideas. 9 out of 10 of them like went nowhere. But it was just like kind of like the start of this just really exciting process.
And I feel like we should back up a little bit, and maybe this is me being a little bit unorganized, but for the people who don't know, right? Because this is more for the traditional crowd, right? On your side of things, what is a DAO? And how is Maker, you and I know Maker has been around for a very long time, especially in crypto years, right? Anyone in the space is familiar with crypto, or is familiar with Maker, is familiar with DAI. But for those who don't know, what is Maker's role within the crypto space? And generally speaking, what is a DAO? Because I think the acronyms in crypto tend to get people really overwhelmed when trying to learn, even though the concepts themselves aren't necessarily always as complex as they seem.
Sure. And I should offer a disclaimer that I am not an expert. There are people who are far smarter than me, who understand the crypto space and blockchain and all that sort of thing. And I would defer to all those folks. But in general, a DAO is a decentralized autonomous organization. So the opposite of a DAO is like us, our bank. We have a board of directors, we have a CEO, we have a president, a C-suite, right? Who are the ultimate authorities in the institution. It's a centralized institution. The DAO is theoretically an entirely democratic organization. So if you have Maker, because Maker has I'm trying to think of it, like how to describe it. Like, so they have two things. They have a product, which is DAI, which is, DAI, the stable coin. But then they also have Maker tokens, which are the governance tokens. So anybody who owns governance tokens in Maker has a vote in Maker. So, and I forget what the number is, how many like hundreds of thousands there are. But, theoretically, you could have hundreds of thousands of people voting for whatever the direction of Maker and the different opportunities that they are or just everyday governance. So it's the idea of like a distributed management, a distributed oversight organization versus like a centralized, more traditional organization.
Yeah, no, that was a good description too. So for not being a crypto expert, but yeah, no, all of the main points, right? So on the distributed part, people anywhere around the world, it doesn't matter where you're from, who you are, what your background is, anyone that has this token has the ability to drive impact and, provide input. And, within DAO structures, generally speaking, because I do want to talk about this with the proposal for HVP and Maker, these are typically run through what's called a forum. And if you are a token holder, people can propose different sort of, movements or initiatives for the DAO. The people within the DAO have a right to vote, like you said, and the decisions really do get moved forward like that. And that's the process, generally speaking, for, how changes are made. So it's a really interesting way to think about things. There are a lot of, DAOs that may not run quite the way that they're intended to, and they may not last. But for the ones that do, it's really, really based upon that synchronicity between many different parties, rather than having 5 people at the top that are driving decision making. Even if they're getting input from others, the decisions come directly from that small group. This is much more collective. So very interesting.
I was saying, correct me if I'm wrong, but I think that Maker is the only major stablecoin that is a DAO, right? Because so. Yeah. So it's a unique position even for Maker to be this decentralized organization and also one of the major stable coins in the world.
Yeah, it's a really interesting position for them to be in too, right? And again, that's why everyone knows Maker somehow, whether it's through DAI, whether it's kind of the innovations that they've had around DAO structure as a whole, and I think kind of more first movers on that front as well from back in the day. But yeah, so using that as the baseline, right? You have this completely decentralized, very Web3 native organization of sorts of all of these different people. And then you have a public company, SEC, FDIC registered broker dealer bank. How did that process work? And what was, coming to a decision on, you said that you had, 10 different crazy ideas of how you might be able to work together. For the people who aren't as familiar with, I say the headline, $100 million loan to the bank. What were the logistics of that deal? And how does a public company like HVB actually get to the point of being able to work with the DAO? That's probably a little bit of a longer conversation that we can get into as well.
Right. The let me see where to back up. So inside of Maker, they have something called the MIP system. So it's Maker Improvement Program. So if you, as you mentioned, if anybody wants to propose some sort of program or activity to move Maker in a certain direction, they go through this MIP process, and Maker has a very specific structure on how that happens. So we have a public MIP out there that was filed, I think, back in May of last year, that anybody can go to and read. And that's one of the most beautiful things about this whole thing is everything is public, right? So there's a 70-page, 60-page MIP that details everything we're going to talk about. And also to back up, and when we were trying to figure out what was going on, or figure out a way to work together, our primary concerns with anything, and this is, cryptocurrency, conventional lending, is that we have to protect the public's money, right? We take deposits and we cannot lose those deposits. So we have a fiduciary responsibility to the communities we serve to protect them as best as we possibly can. Now, part of that is also making income so that we can continue the bank to survive and thrive and grow. And so that, is one way of also, protecting that. And when you're a smaller organization, you have limits on what you can do. So there's legal lending limits that is the technical term, in the sense that, like, if I was going to go out and lend money, to the public, I couldn't exceed certain dollar amounts. And that is also to make sure that the bank doesn't fail, right? We learned a lot of things during the Great Depression, going back when banks failed. So, like, you wouldn't want Huntingdon Valley Bank, which has $500 million, just call it $500 million for the sake of argument, of assets, to go lend out $500 million, right? If that one deal went bad, the whole organization would go bad. So with Maker, and some of the dollar amounts that they were talking about, our first concern was we have to scale this down a little bit to make sure it works, because we don't want to do anything that would jeopardize the bank or jeopardize Maker. So we're very careful about that from the get-go. And one of the ideas that we eventually landed on when we were trying to figure out a way to use this debt vault structure was to say, we work with a lot of other banks, right? So if, Caitlin, you wanted to buy a $12 million investment property in New York City, right? Just assuming that we are, say, Philadelphia, because we probably wouldn't, be in New York City. But if you, we could not do that whole loan ourselves. We would bring in a partner bank, and then jointly the two of us would fund that deal. You would work with Huntingdon Valley Bank, but in the background, we would have a syndication or participation with another bank. So that model has been around forever. So we said, well, why don't we take that existing model? Maker wants to, and I'm just, I'm oversimplifying this a little bit, and Maker wants to, invest in these real world assets, and we'll say, all right, well, instead of us doing a participation with a bank, we'll do the participation with the MakerDAO. An entity was created, I'll get to that later. And so that was like the basic simple idea, is that Maker would be able to leverage its funds without having to hire a whole system of people, of loan administrators and underwriters and, et cetera, all the different people that it costs, that go into, running an organization like a Huntingdon Valley Bank. They wouldn't have to do any of that. They would just be a participant in deals that we source, that we underwrite, that we book, we close, and then we service. And because the bank would hold a percentage of it, where we hold at least 50%, if not more, then there's also, not having like the right word, but there's an incentive to also make sure that we are holding good assets and that they are buying good assets, right? So we never want to ever do anything that is not in the best interest of any of the different parties. So that's really what the core was, is that these funds would be like a lender with the bank, but the bank essentially does all the work. and then but gets the benefit of having, you know, the Maker balance sheet as well.
And they have quite the balance sheet, right? So I think that's something that you and I had talked about before recording as well. The end amount for the deal was $100 million. Is that where it started? How much were they originally trying to shell out to you guys, and how does that differ from the relationships that you typically have with, say, another bank?
So the only thing I would say, and you know, obviously, like, we're a public company, you're a regulated company, so I always have to be careful of everything we say. But and also when we say they, Maker wasn't offering anything, right? There's an intermediaries who were helping facilitate the transaction based on the communications from MakerDAO. So I just want to be, you know, just to be clear, I don't want to put words in anybody's mouth. We eventually work with Maker, but, like, you know, and they're
speaking. Gotcha.
Yeah, I just would be, you know, just be careful in the core units over there. But anyway, but yeah, they were looking originally somewhere between like $500 million and $1 billion of what they were looking to deploy. And because, you know, our asset base is, you know, it fluctuates based on, you know, timing and, you know, what's going on. But just say, you know, again, it's $500 million. Like, we literally could not deploy $500 million of assets. Like, we would have to walk away from that transaction because it would not be in the best interest of anybody's party. So we scaled that back and said, you know, if we are going to move forward, we would like to test this out with a smaller facility, you know, and the $100 million seemed like a something that we could deploy within a reasonable amount of time based on our run rate of originations and, you know, where we see the bank going. And that was what we pitched. We just said, hey, we could do this level, we can't do that level. And it seemed like everybody was on board with that, you know, at a minimum, you know, that it seemed like it was in the best interest of everybody's to be conservative. Because at the end of the day, like, we're always, this is one of the benefits. And this isn't like working with a bank, because we are so highly regulated, like, you know, that you don't have to worry about a lot of different things. We're also conservative, right? We are going to make sure that we you know, we get the highest return on the most secure, safe assets for us and for them.
Yeah. And it's something that you don't see on the native crypto side quite as much, just with it being such a nascent space, with the regulatory component of it being, you know, very much opaque, at least in the States, in terms of, you know, how people can operate and the guardrails around it. When it came to,
well, or if we were a private equity fund, or we were a hedge fund, or a private investor, then you Maker also, I don't think, would have the confidence to know that those folks would have the best interest of all the parties, because the interests might be different or might be misaligned. At least in this, we are entirely aligned in generating a satisfactory yield on the safest assets possible.
For sure. And let's talk about the considerations of, you know, going forward with this. Obviously, the announcement went out in August of last year, I think I said, and it is now March of 2023. So very much, I would assume, kind of through the thick of, you know, all getting that transaction, you know, done and getting all of the logistics of it figured out from a regulatory perspective, from, you know, looking at this top down. This was one of the first deals of its kind, really. So how did you and your team go about creating the rules and guardrails for what a deal like this looks like and how to go about it? Because it seems like it had to have been, you know, not much precedence to go off of in terms of how this has been done before, right? To say the least.
No, you're absolutely right. In fact, I would make the bold statement that it is the literal first of its kind to ever have occurred. I mean, it's kind of exciting for all of us that, you know, to have been involved in this. As soon as we realized that there were some legs to this, you know, because like I said, we get lots of opportunities for different investments, and most of it we say no to. But as soon as we realized we had legs to it, we immediately involved our CEO, compliance, you know, right away. Just because, like, anything you do inside of an organization like this, you have to make sure that we're not violating any rules or regulations. You know, we're protecting our clients and the bank and the investors. So I mean, right from the get-go, I think everybody was involved. All the people who needed to be involved were involved. that being said, then we had to fine tune a program that we believed that the regulators would not necessarily accept, but they wouldn't decline, right? Because if think about it this way, there's no upside potential if you're a regulator or a credit person or anybody to, an auditor to ever really like approve something, because, you just don't, what's the upside of approving something? There's a lot of downside risk. So in a lot of these cases, you're always just not getting a declination. You're not really getting, so there's like a tacit, acceptance. So the number one thing that we wanted to make sure of was liquidity. So if we had, let's go back to our example, like where I said, like, say you wanted to buy a real estate, investment in Philadelphia. Well, say you had to construct that real estate, that investment, that building, and it was $12 million. So we gave you a $12 million loan. But because it's a construction loan and there's 18 months of construction, you may only have a couple of $1 million outstanding at settlement. And then over the next year, it draws down. So that drawdown process means that we need to make sure there's funds available to fund that. So if we did a loan with Maker and they said, okay, well, we participate in this, we're 50-50, but there's only X amount outstanding today, but there will be Y amount outstanding in the future. We need to make sure that there's that Y amount outstanding in the future. Otherwise, there's going to be a liquidity crisis. So to resolve that problem, the liquidity problem, we gave Maker an option. We said we could look at this two different ways. We could look at this as a total commitments of the 100 million, right? So say 50 million was committed, but only 20 million was drawn. And please, by the way, just stop me if anything is like, if I'm getting too in the weeds. But that they would then fund that amount, pre-fund that amount, so that that we could make sure that there was always a sufficient amount available, or they could fully fund the whole $100 million. So we gave them the option of one or the other, and they decided to fully fund the full 100 million. Now, the next question you might say is like, well, fully fund where, who, what? Because this was actually one of the most fascinating parts of the whole process, is that, who is MakerDAO, right? What is MakerDAO? Right? I mean, it's a protocol, right? I mean, it's a decentralized protocol. So there's no Mr. MakerDAO or Mrs. MakerDAO who is making a decision. There's essentially like no legal entity. So there is a trust that was set up that by Maker as part of this process, that is the actual party to the facility. So there's a trust held at another bank who is the trustee and has all the trust powers. Again, that's completely independent from Huntingdon Valley Bank. And that trust, the beneficiary of that trust, is the MakerDAO protocol. So the MakerDAO protocol funded, issued $100 million a DAI. That DAI was converted by Genesis into dollars, and then those dollars were funded into this trust account. And then that trust, which is a legal entity, is our participant in these transactions. So they fund the principal for the loans, and then we fund back to them any of the payments, the interest, essentially all the income back. And then they convert that back to DAI. That then goes back to Maker.
What a process. I just can't imagine being in the conversations of trying to figure that out, right? So you look at this DAO, how do you think about it, right? To your point, what is it? How does it work? There's no one person to go to talk about these things with, right? And there's no, central point that you can be having these conversations with. So there's a lot of hoops to jump through from that regard, and someone had to be the first. So I guess it was going to be HVB, but that's something that you're never going to get around in the crypto space if the ethos of it is around decentralization and, not having the power in the hands of a very small group of individuals. You're going to run into this issue time and time again in a variety of ways. And it's interesting to think about how you work through it. And there are ways, clearly, because
and the way that Maker, and the way that Maker solved that problem is they created the core unit structure, where they essentially voted on and said these folks all across the world are our experts in finance. And so they're going to be our finance core unit. They're going to review this whole transaction for us, help structure it, work with the bank, and then present that whole package for approval by the community. So it's interesting that you have this little bit of centralization, like, because you need to, right? Because if you had 100,000 people vote on every single transaction, every single thing, like, it would be, nothing would ever happen. So there has to be some sort of specialization, and that's who we work with. We worked with, really a group of wonderful people at Maker who helped move the transaction along, and then queued it up for the subsequent votes by the community at large.
Got it. Yeah, no, that makes a lot more sense. You have to have it a little bit more organized than just a group of tens of thousands of people to vote on every single
right. Yeah, that would be in anything. I mean, imagine in the United States if everything was voted on. Like, nothing would ever be done. That's why we have representatives. Yeah,
exactly.
That's a different conversation, but
very different. So Maker fully funded that 100 million. Fast forward to today. Everything with, that entire transaction. How did that end up working out? Where are you at today with HVB and this trust? What does it look like today?
Well, so wait, can I just say two funny things? One is that we believe this might have been one of the most regulated transactions ever, because you had the FDIC, Federal Reserve, the SEC, FINRA, because there was a broker dealer, involved. There was somebody else as well. I forget. And then on top of that, we helped clear some of the KYC, know your customer, AML, anti-money laundering issues, because when everything was finally approved and then Maker was getting ready to fund the funds, they split it up into 4 $25 million tranches. And after the first one funded, so they minted 25 million in DAI, sold it, and then process it, and then in the middle of that process, the tornado went down. The tornado coin, and there was all this angst, with a lot of people, like, saying, like, what's going on here? And it paused it for a moment, particularly with Genesis, who is, I know, subsequently has had issues in other areas of the company that I don't really know a lot about, but the people we worked with on the trading side, they were fine, because everybody got together and we worked together to figure out and make sure that everybody was comfortable on the KYC AML side, and then finally closed. But there was definitely like a couple of weekends of like hand wringing and working really around the clock to make sure that it settled. So since then, because so that was July, it closed. The technical closure was July, and we had a couple of things queued up to sell into it at that time. And what we wanted to do is we wanted to look at, okay, well, here's a couple of different types of loans that go into this. Let's see how each of these works, because the very last thing we wanted to do was have a major problem and create an issue, both for us, but also for the Maker folks. I mean, we're really trying to be sensitive to them as well. So, we tried like a conventional mortgage, a line of credit, looked at these different things, something that had like a couple different layers of participations. And so rather than, and also I just want to add one more thing, is that we also fought very hard that one of the benefits of working with a bank is that we have a very wide diversification, right? So, I mean, we have part of being regulated is that we have certain percentages that we can invest in different areas, right? So you don't want to have a bank only have, all of its loans are to, public storage, right? I mean, that, like, you don't want to have a concentration like that, because if the whole public storage industry goes down, then the bank goes down. So what our loan portfolio is very well diversified. And so we said, your portfolio should also be very well diversified. And so essentially you want the Maker facility to mirror the diversification of the bank's asset pool. We also, because we spent a lot of time, this is going backwards. We spent a lot of time saying this is the first transaction of its kind, and we want to protect Maker and other folks like Maker in the future from from being taken advantage of. So we said, okay, let's take our Huntingdon Valley Bank hats off and say, if we were going to advise these folks on the best way to proceed, and you know, regardless of who the party is, how would we structure this? And so we came up with, I don't know, you know, a dozen different metrics that, like, the only way a loan could be participated is if it hit each of these metrics. Some of them were credit quality, some of them were performance, some of them were, you know, economic based. So that way, like, they would never be, like, say Maker did another deal with a bank somewhere else in the country that had a lot of bad assets, and those bad banks said, hey, we'll put all these bad assets in this deal. This would prevent that from happening. So, you know, we carefully structured it to protect them and also to, you know, make sense for the bank. All that being said, and I know that, like, Maker probably would want this to move faster, but it really, the concern about going any faster is that then you start, you know, moving the guardrails, and then, you know, then you're introducing a problem that, you know, potentially could be a bigger problem later. So I fundamentally believe that we took the time to do it right on the front end so that it's working well now. And it is. I mean, we're you know, we had a, you know, slowly, you know, put some, you know, did some partnerships, participations, some assets into the fund, made sure those worked, right? So we had a, you know, a month or two making sure that everything worked back and forth and there was no issues. And we're still fine tuning some of the reporting. And now we have queued up a number of other, there's a pipeline of stuff that is going into it as well. Now, of course, in the midst of all this, interest rates have increased at historic rates, right? So you went from March to March. I think prime rate more than doubled in the US. Treasuries have more than doubled. You know, all sorts of things have changed. So that can have a double-edged sword, right? Because in the fourth quarter, I think everybody nationwide slowed down, as, you know, as every investor and borrower and company owner said, okay, well, let me see what's going on here before I move to the next step. So you had a little bit of a slowing in the fourth quarter. But then the second thing is like, you know, what does that look like for yields and for structuring and making sure projects work? So all that feels like it's not entirely behind us, but at least, like, it seems like the investment community, the business communities have a little bit more of a handle on that than what they did, you know, with the fourth quarter of 2022. So that being said, you know, we have a couple of really fantastic relationships that we're partnering with them on. That the yields are really strong because prime is so strong at the moment. You know, because of the, you know, with the fixed versus floating, and it seems like it's working well. I mean, we're really happy with them, and, you know, hopefully they're very happy with us. But it being a DAO, you don't really know because there's no
Right.
nobody to call to, you know, make sure.
You have to send out a poll, right? See what feedback you get.
Now, the only danger with that, though, is that we all know, like, in our internet age, is that as soon as you put something out there in the public, in a forum, you know, you might always get, you run the risk of always getting, like, the lowest common denominator, you know, like, commenter, right?
Yeah, the people who feel the most strongly about commenting on venues like that are usually the ones who feel the most strongly, and usually the most strongly in a negative way.
Right. There's not a lot of people who go to Yelp and say how much they love a restaurant, but there's a lot of people who say they don't like it. Yeah,
exactly. Yeah. So maybe you guys don't do that, and just assume that all is well, unless told otherwise.
Yeah.
So thinking about this from both the HVB side, and of course, I know that you're not part of MakerDAO by any means, but what is the view on transactions? I don't know if I want to say partnership really be the right word, but situations like this moving forward, both from HVB's side and from what you've seen or heard from Maker. Is this the type of relationship that you see happening continuously? Do you see this being a bit of an outlier event that you may not necessarily pursue again in the future? How is your team looking at, you know, the future of traditional finance with HVB and working with people on the crypto side or groups on the crypto side?
Yeah, I can't speak for Maker because I don't know how, you know, what the interest level is going to be, you know, with with real world assets and their investment going forward. And I hope that they continue going down this path because we're at the very beginning of this era of traditional finance and DeFi, coming together. When I talk to people, I always say, like, until you can buy a cup of coffee with, your cryptocurrency, like, and drink it, like, you like, it stays in the digital world. Like, there needs to be like a merging of these two things. I will say in the course of this whole process, our chief lending officer and myself did the intensive cryptocurrency course at MIT, the online course. So we got like a crash course in crypto, and coming out of that, and I know I'm not entirely answering your question, but coming out of that, like, there are some really, really exciting things that you can do in the blockchain, like particularly with regards to, electronic transfers of money, right? Where, you can track and transfer across the globe in a way that, like, we can't really do it or do it as easy or as securely with the traditional models. So, outside of Huntingdon Valley Bank, just as a financial system as a whole, you could see how the blockchain and Web3 is going to revolutionize just inter-entity monetary transactions. And who knows where that's going to go. I mean, but that is, like, really exciting stuff. But in that whole vein, if that's the case, then, why aren't there more opportunities to use, the digital balance sheets for other areas of finance, right? Or derivatives. And I think you're at the forefront of, that whole, aspect of it. But so the short answer is we would work with somebody again. Absolutely. Because from this experience, and also from just seeing where we are in this digital economic landscape, we're moving in that direction.
I absolutely agree. And it's refreshing to, hear from people on the traditional side who are really gung-ho and excited about all of the opportunities, because, like you mentioned at the beginning of this, and I had explained it to anyone the same way as you did, what crypto and blockchain are enabling, it's really just a continuation of everything moving towards what we're seeing today, this very digitally native world, breaking down barriers across, different countries, different continents, regardless of where you are, and making that frictionless. And this is just another step in that process. I think we really try to overcomplicate it with a lot of the, I don't want to say noise, but a lot of the, a little bit more out there innovations that we've seen on the crypto side that might get more of the headlines. But at the root of it, I mean, that is really what this space was, at least originally, brought about to solve for and to improve. So it's refreshing to hear from someone at a bank that, was open to doing a transaction like this initially, say that this is where the puck is going and we want to skate in that direction, because I think there are a lot of, traditional institutions and traditional players that could be, taking notes on that.
One of the most interesting things I discovered out of this, because we got a lot of calls. I mean, we got a lot of publicity, and, it was a lot of inbound, conversations, and, people in different parts of the country and the world reaching out and having conversations, is how many people are quietly working on similar things. That, like, there's like you said, there's the public kind of, headline grabbing stuff, but behind that, and it's like, that's like the tip of the iceberg. Underneath the water is a lot of institutions and a lot of momentum moving forward, trying to solve some of these problems. And this problem that, like, Maker, I mean, it's not a problem, but, like, Maker saying that, okay, I have this giant reserve of funds. How do I best utilize this reserve in a way that preserves those funds, but also creates a yield, and a diversification? It's kind of a brilliant idea to start investing in real world assets, and also then now queue it up. Now, here's the interesting thing: Maker now has a direct link with a traditional regulated financial institution, right? So, I mean, it's like, we're talking a lot about, like, us going that way and how we can benefit. I mean, but Maker now has, this connection and this relationship. And so surely there's other ways that can be expanded and also that they can benefit from.
That brings about a more general point, not even necessarily talking about Maker specifically, but from a regulatory standpoint, I know you are not crypto native. You're viewing this from more of a traditional lens, though, which I think would lend an interesting perspective. How do you see, crypto regulation moving forward when you've been involved in transactions like this, right? You see the merging of it. You see that it's inevitable. You see, from the conversations that you've had that there are traditional entities interested in this, but there still is a stigma for many people around the crypto space, understandably so, and the way that a lot of these different projects and DAOs and, protocols operate. So I know we talked about self-regulation a little bit offline. I think that's an interesting conversation we could get into here among anything else you want to add.
Yeah, I would say I am not a, in my career, I've met lots of bankers who are like anti-regulator. I'm not anti-regulator at all. In fact, I'm pro-regulator because, first of all, these are folks who have very, very difficult jobs, and they don't get the benefit of doing some of the more fun and exciting things that we do. So like, I have a lot of respect for the people out there who are really smart people who are spending a lot of time trying to regulate institutions. And if people understand that regulation is about protection, not about making your life more difficult, then I think that little bit of reframing of the conversation might help. And if this a year ago, I think that the crypto community probably would have had less of a patience for it. But we've seen a lot of people lose a lot of money in the past year, right? And this is exactly what the regulatory community is trying to do. They're trying to protect you. They're trying to protect me. They're trying to protect my neighbors. They're trying to protect the retired folks on a fixed income and the person who's investing their first $1,000. They're trying to protect them from losing everything. Because there might be some people who were acting irresponsibly or who were bad actors or who didn't think through all the consequences of what they're doing. So regulation is not bad. It is meant to help all of us. And I think that is a really important point, and I hope that really gets out there. Because then it creates a situation where when you know the rules, the sky's the limit, right? And we should have a couple of rules that say, I shouldn't take your money for my benefit, right? Like nobody wants that, maybe the person who gets the money does, but it doesn't help our society and economy at large to have those types of, what's the guy, the FTX guy, right? The guy gambled with a lot of people's money and it's really sad. There's a lot of people who lost a lot of money and that's really sad. There should be consequences to that. So one of the things that like the community could do is like, if you are so concerned, if the community is so concerned, and this is just my opinion, I just want to preface that by saying, but if the community is so concerned about regulation, then the community should offer up suggestions on how to regulate versus like waiting for whomever to regulate them, right? And that crypto course that we took at MIT was taught by Gary Gensler and I forget the name of the woman, but both excellent, smart people. And now he's the head of the SEC and he has a really good understanding of the crypto space. So a lot of his actions have been based on this of trying to protect people from the stuff we just talked about. So if there was anything the crypto space could do, would be to say, maybe form a coalition and start jumping ahead of the issue rather than complaining and then not doing anything and then being dissatisfied when you don't have a seat at the table later on.
It's such an interesting mix that you see within the space as well, right? Because the people that are, very aggressively like anti-Gensler, I can't say I'm particularly a fan if we're being honest, but like the very openly, explicitly against regulation or, not happy with how it's being handled, at least in the States, you see that more often than not, right? Because it's a little bit more of the polarizing content commentary. But, that being said, to your point on being a little bit more self-regulatory, a little bit more proactive, there are definitely actors within the space who would gladly chime in on that for sure. And I think have a bit, but it's more of that sort of like people say like based content. You don't see that getting as circulated, right? Because it's not the sexy stuff. It's the stuff that matters. but it's not going to get, people all fired up and, arguing more about something that is already a heated topic. So I definitely agree on that. You can't wait around forever, and offer up solutions rather than complaints is definitely a good way to go about just about anything. And especially in the US, I can't really speak to, other jurisdictions, but there's a long way to go when it comes to crypto guardrails and implementing rules.
Well, it doesn't seem like the government yet knows who is going to even regulate it, right? So that's, you'll see the first start there, and then trickle down. And we have, again, not to continue being pro bank, but if you think about the banking industry and the investment banks, all that, you have a industry that's been around for several hundred years, right? And has fine-tuned capital delivery in a way that nothing else has, right? Not even the private equity, any of that, because they have different. So, you have, and then you have, regulators who've been fine-tuning their specialization for a couple hundred years as well. So there's a lot of really good institutional knowledge and understanding out there of how to protect the public while creating the platform for future growth.
Fingers crossed.
I'm an optimist, so I
appreciate that. I think the world needs more of those for sure, and especially if you think about crypto and you think about the innovations that you and I have talked about and the potential that it has to really improve on a lot of the systems that we use day to day. There, and as you know too, right, it's decentralized. There's no fully shutting that down. It's finding a way to work with it in a way that does protect people. To a reasonable extent, like our traditional financial system. So definitely a lot to think through there.
Yeah, and again, go back to the FTX. If you ask some folks who, some people who had money on hand at FTX who've lost everything, ask them what they think about regulation right now. They might have a very different tune than what they would have, 6 months ago. So, but hopefully there aren't that many costly lessons, right? That we can learn some lessons without having even worse things happen.
Yeah, that's the unfortunate reality, is a lot of the time it takes a very extreme situation to get, that drastic reaction and actual, bring people to action to really fix things and provide clarity sometimes, which is unfortunate, but
absolutely. But on the flip side, that's why you have us who are very careful, thoughtful, really want to make sure that this facility with Maker is absolutely successful, so that it creates a framework for something else. Whatever the next, iteration will be,
That's the part that I find in coming from the traditional side and going into crypto, a really interesting juxtaposition from people who come from a very highly regulated space versus those who don't. Those who maybe were in very, very different industries before working in crypto, whatever it might be, the mindset around this whole idea of moving fast. It means different things to different people. And you see people, you need sort of a group of people to balance out the ones that are very much on the move fast and break things side, because there are consequences to that. And that you have to balance out that, the speed of innovation and the speed of, really wanting to just try things and put them out into the world and iterate on them. There needs to be some thought put into the process around making sure that it's done reasonably. So it's not the sexy point of view at all, but it's the way that things need to be approached if you want it to be sustainable.
Yeah. Well, so our philosophy might be move quickly and maybe crack them.
It just doesn't roll off the tongue quite as well.
It doesn't quite. Yeah. It's I'll workshop that a little bit.
Yeah, no, we'll brainstorm on it after this for sure, but I like it. So last thing I want to ask you about too, again, coming from the traditional side, having a bit of a different viewpoint from a lot of the people that I tend to talk to who have either made the transition over to crypto, working in DeFi, whatever it may be. What do you see as, you mentioned a lot of the potential for blockchain and crypto in the future. Where do you see the biggest opportunity for traditional institutions like an HVB to get more integrated into this up and coming DeFi space?
That's a great question. Specifically for banking, I think there's the payment processing side of it, where the security of payments, the speed of payments, the tracking, and all the the ability to like the ledger based side of it and the blockchain with the payments, where you can go back and see literally where everything moved, but also just the instantaneous global network of it. I mean, that's going to be huge, but I mean, that's still very early stage. So I can't see like other than maybe like a giant bank, one of our huge, Citi, Chase, Wells. I imagine like one of them would probably like the folks who brought Zelle. I mean, yeah. I could see those institutions coming up with something that then trickles down through the whole system. But the other side of it, and that is going to come. I mean, if we had this conversation in 5 years, I think we'll be like, wow, that was old hat at this point. The other thing though is the it was really exciting to me, and what I love is the collateral side of it. That like linkage and tracking of collateral back to, or the securitization of collateral back to the financial instrument. Because like if you were shipping copper around the world, right? And you're lending money on that copper, you want to make sure that copper gets from A to B. So if getting to and there's a lot of like kind of like problems that need to be resolved related to this. Like, how do you connect the digital tracker to the physical asset? But there's people who are working on that stuff today as well. But I mean, just imagine like if you had real-time access to all of your assets anywhere they were in the world, and clear title to that and tracking of it. I mean, that's huge. I mean, it's huge. I mean, a lot of like the losses that institutions face is because, of the disposition of the collateral side of it. And then just the last thing is just like the new products that are going to come out of it. Like imagine like a fully crypto native home mortgage. I mean, that will come one day, right? Somebody's going to figure out how to do that, and that's going to be a product that if you have all your assets in cryptocurrency, you make all your money in cryptocurrency. How do you get a home mortgage today, right? It's almost impossible to do it because it's not compliant under. And I'm not a residential mortgage expert by any means, so like don't think this is gospel, but I mean you could see that there will come a time where there's going to be a digital, fully blockchain, mortgage product, and then just layer in all the other things, beyond that. So it's hard to say like, what's next, because there's like, it's completely wide open. The field is completely wide open of what's going to happen next.
Possibilities are endless. It's definitely fun to be in the position to be thinking about these things now, just because you think of all of the like revolutions, like tech wise, that have been very disruptive to society, and we're sitting straight in the middle of it now. And I'm not like a rah like very aggressive maxi on anything. I don't really find that that's typically productive, but it really is something to be excited about. And I think that when more people realize that, when they really dig in and learn a bit more about the possibilities of it for what's really practical, right, there's a lot to think about there. And we're literally scratching the surface. Like what we talked about today with HVB and Maker is just the start of that intersection. And there are so many possibilities there that we haven't even thought of yet.
Well, and you had a great word, is the practical side of it. So, practical solutions to new and old problems without like burning down the whole system is what's going to be the most successful.
Definitely agree. And we're kind of more in the experimentation phase right now with a lot of the stuff that we see people focusing on more like gaming and metaverse. And, there is there a place for that? I don't know. We'll find out in 10, 20 years, but, people are going to at some point come back to first principles. And there are people working on this of how do you really change, the fabric of what's most necessary and like where this makes the most practical sense. So yeah, very excited about that. Got a long way to go for sure. But Dan, thank you so much for coming on. I really appreciate it. And thank you to everyone for listening. We will be back next week with another episode.
Great. Thanks so much. I appreciate it.
All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of the hosts or any of their affiliates. This podcast is for commercial and informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities or cryptocurrencies, nor is this an offer or sale of a security or cryptocurrency.